Hello, I'm Megan, and I love investing in real estate and empowering others to do the same. Today I wanted to talk about the BRRRR method. This is one of the most powerful ways for new investors to get started in real estate, or for seasoned investors to continue investing in real estate without leaving a lot of money in the deals. There are lots of creative financing options out there, but this is one of the easiest and most powerful ways to have low or no money down in your rental properties. So today we're going to go through the 5 steps of the BRRRR method and talk a little bit about why this is so powerful. Step number 1, buy. When you buy a property for the BRRRR method, it is ideal to be able to purchase and renovate the property for 75% or less of the after repair value. So if the property is going to be worth $200,000 by the time you're done with it, you want to purchase it and renovate it for $150,000 or less, ideally. If you can't fit in that $150,000, that's okay. We'll talk a little bit more about that later. But what this means is that you're going to have to be buying properties that are distressed. Oftentimes this means it needs work. Maybe the roof and foundation have issues, or it's really outdated and you need to do a lot of cosmetic updates. But sometimes it's just that the seller is in a distressed situation. It might not need that much work, they just need to get out quickly, and so they're willing to sell it at a discount to be able to move on with their lives and whatever is going on with them. Whatever the case is, distress is an important part of finding a property that fits the BRRRR method. Once you've purchased your property, step 2 is renovation, which I think is one of the most fun parts of the process. When you renovate, you want to make sure that you're renovating it so that it's going to be a really solid rental and very competitive in the rental market. You want to get top rents so that when you go to refinance it, not only can you show all the work you've done, but you can also show that you've got really solid rent in place and the property will cash flow. So once you've gotten through that renovation process, step 3 is to rent it out. You want to ideally find the tenant before you go to refinance with the bank, because then the bank already sees the income that you're generating from this rental property. Step 4 then is to go to the bank and get your refinance done. So they're going to look at what you bought it for, the work that you put into it, and the rent that you're getting on the property. They'll have an appraisal done, they'll look at some comparables, and they'll decide what the property is worth. Again, hopefully you put about $150,000 into it and they think it's worth $200,000. That means that if they're willing to lend 75% of that value, that you have now covered all the costs it took you to get into that purchase. Maybe you end up spending $160,000 or $170,000, and that's fine too. You still have less money left in than if you were purchasing a property at $200,000 and you had to make a $50,000 down payment because of the traditional 25% down. So even when it's not a perfect BRRRR, the BRRRR method still has its benefits when you have to leave a little bit of money in. Once you've gone through all those 4 steps, step 5 is just to repeat. You now have your money pulled back out, and so you can go put those funds to work in another deal. And that's really the power here, is you don't have to save up for a property for a few years, make the down payment, and then save for another few years. As soon as you have that property refinanced, you can rinse and repeat, go find your next property, and stack up those rental properties a lot more quickly than if you're just saving 25% every single time. So let's look at this mathematically. You can see here that I have 3 examples. A traditionally financed property where you purchase it and put 25% down. A BRRRR where maybe you do have to leave some money in, but it's only about 10% of the actual purchase plus renovation price. And then a perfect BRRRR where you're able to take every dollar back out and you have no money left in the deal. So let's say in all 3 of these examples, the purchase plus renovation is $200,000. Now, in the traditional example, you're going to have to put $50,000 down for that property. If you do a BRRRR and it's not perfect, maybe you're leaving $20,000 in it. And if you do a perfect BRRRR, there's no money left. I'm going to assume annual cash flow on this property is $200 per month, or about $2,400 per year. So that means our cash on cash return in these 3 different scenarios goes from 5% with a traditional purchase, up to 12% with an imperfect BRRRR, and then to infinite with a perfect BRRRR. That's a powerful shift in the cash on cash return that you're getting for that property, just because you took the time to find a more distressed property and you went through some work before you went back to refinance it with the bank. So I hope this helps you understand the BRRRR method, what the steps are, and why it's so powerful. I hope you take away from this that it doesn't have to be a perfect BRRRR for it to be powerful. Even if you have to leave a little bit of money in, your cash on cash return is still higher than it would be with a traditional purchase. And you have some of that money coming back out to go take into your next property. And you're able to purchase your follow-on rental properties a lot faster. As always, let me know in the comments below if you have any questions about the BRRRR method. If you want to dive in further on cash return and other real estate calculations, I just did a video on that recently too, so check that one out. Keep learning, keep growing, and have fun.